Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. If you've been following the channel, you'll know that China has been suffering problems in 2023. At the start of the year, there were high expectations that China was going to deliver 6.5 to 7% GDP growth. However, over the course of the last 9 months or so, those expectations have been realigned, and China is now hoping to deliver 5% growth, which is a material fall from where it thought it was going to be. And one of the major problems that China is suffering from is deflation. Prices on the shelves are actually falling year on year, which may sound like a fantastic opportunity if you're a consumer. Everybody wants to pay less for things when you're going to buy stuff. However, if you're a producer, if you're a company or a manufacturer in China, the last thing that you can afford is to drop your sales price, particularly because of all of the high levels of inflation that we've seen around the globe over the last 2 years, because that's been pushing up the raw material prices that most Chinese companies have had to pay. And in addition to that, China's also experienced a major fall in the value of the yuan, which means that the purchasing power for Chinese companies has also fallen. So in today's video, we'll have a look at what's going on with the current rate of inflation in China. As I mentioned, it's actually in deflation now, so prices are down year on year. We'll also have a look at what's happening with food prices, because that's a metric we always like to have a look at, and I can tell you that food prices are also falling. We'll then talk about producer prices, factory gate prices. This is the price that companies are selling their goods once they leave the factory, and they're also down year on year. We'll then talk about what causes deflation. How did China get itself into this position? Most countries around the world are trying to tackle high levels of inflation, so having falling prices almost seems like a luxury. But actually, if you do find yourself in a state of deflation, it's actually really bad news, and it's a very difficult situation to get yourself out of, which is what Japan have found over the last 20 years. We'll then go on to have a look at which other countries are currently experiencing deflation. There are 11 of them in total. And then finally today I'll wrap up with my summary as to what I think the major issues are that China are currently facing, and whether or not they're going to be able to get themselves out of this situation. But before we get started on all of that, once again, I'd like to say thank you so much to everybody that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that. Thank you very much. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon account, as well as buymeacoffee.com, YouTube super thanks and YouTube membership scheme. This chart shows the movement in the official rate of inflation in China over the last 12 months. And this really highlights the problems that China is experiencing right now. As you can see from the left-hand side of this chart, inflation was actually rising in November and December and hit a peak of 2.1% in January. And that was the point when everybody was expecting China to have a very strong 2023. The COVID-19 restrictions had finally been lifted in December 2022, and the prospects look good for strong economic growth for China, which would have potentially delivered strong inflation. However, the problem that China encountered was that as they came out of their COVID lockdowns, the rest of the world was starting to slow down economically, and so demand for China's products started to weaken. And at the same time that that was happening, the problems in the Chinese economy started to reduce domestic demand, and those factors had a negative impact on inflation, which fell to 1% in February, 0.7% in March. It then dropped dramatically to 0.1% in April, increased very slightly to 0.2% in May, hit 0% in June, fell to 0.3% negative in July. In August, inflation increased fractionally by 0.1%. It then fell back to 0% in September, and the official rate of inflation for October 2023 is minus 0.2%. So if you take a step back and have a look at the right-hand side of this chart, you can see that China has been struggling to achieve price increases for the last 7 months. And in 4 of the last 5 months, there has been no growth in prices, and in 2 of those, China has experienced deflation. This chart shows the movement in food prices year on year in China over the last 12 months. And what this chart shows is that the movements in food inflation have been more pronounced than general inflation. In the first 3 months here, November, December and January, there was a rapid increase in food prices which hit 3.7% in November, 4.8% in December and 6.2% in January. The increase in food prices then dropped to 2.6% and 2.4% in February and March, 0.4% in April, 1% in May, 2.3% in June. However, in every one of the last 4 months, there has been a year-on-year decrease in food prices. And as you can see from this chart, the decrease in food prices is now accelerating. It was 1.7% in July and August. It increased to 3.2% in September. And in October 2023, food prices in China were 4% lower than they were in October 2022. Now, you may be sitting there thinking, well, actually, that sounds like good news because a reduction in food prices has to be good for consumers. And there is an element of truth in that. But the problem that China has is that what's good for consumers isn't good for food manufacturers. All of the companies in China that are involved in making food have experienced a year-on-year reduction in their selling prices. And that's obviously a problem for businesses because unless all of their costs have fallen by 4% over the last 12 months, they are now making less profit. And in a lot of food companies, the margins that they're achieving are quite slim. So if you have a year-on-year fall of 4% in your selling price, it could turn your business from making a profit into making a loss. And the overriding concern when you look at this chart is the trend in 2023. At the start of the year, food prices were increasing by 6.2% year-on-year. However, over the last 10 months, there's been a consistent decline in food prices. And if that trend continues through the rest of 2023 and into 2024, some of the businesses that are producing food in China may actually become insolvent, so they can't continue trading. And then you have an issue with regards to food security, because if the companies that are producing food can't continue operating if they don't have any cash flow, that could start to result in empty shelves on Chinese supermarkets and problems for the economy. This chart shows the movement in China's producer prices over the last 12 months. And the producer prices are also known as the factory gate prices. So this is the price that factories are selling their goods at once they are finished, once they're basically going to market to be sold. And as you can see, in every single one of the last 12 months, producer prices have fallen year on year. In November 2022, producer prices were down 1.3%. There was actually an improvement in December when producer prices only fell by 0.7%. However, between January and June 2023, there was an acceleration in the fall in producer prices, moving from 0.8% in January to 1.4% in February, 2.5% in March, 3.6% in April, 4.6% in May, and fell year on year by 5.4% in June. Now, over the last 4 months, there has been an improvement, with producer prices falling by 4.4% in July, 3% in August, 2.5% in September, and in October 2023, the year-on-year movement in producer prices was a fall of 2.6%. And the issue here is exactly the same as we've just discussed for food prices. This is good news for consumers because it means that the price of things on the shelves is going down year on year. However, it's very bad news for business because unless all of your costs are falling at a faster rate than your prices, you're going to have a reduction in profitability. And the problem for a lot of the Chinese manufacturers is that they're working on a volume basis. They need to sell a high volume of products for a small amount of profit to make their net profit. And when you get a situation when your sales price is falling, that can completely wipe out your profit margin. So there is a genuine risk that a lot of businesses in China right now are not making any profit as a result of the fact that they're selling their end product for a lower price today than they were this time last year. And in the vast majority of cases, their costs will not be falling because China buys a lot of raw materials from overseas, which it uses in its manufacturing processes. And as we've talked about a lot on the channel, many economies around the world have been suffering from high levels of inflation, which means that producer prices have been rising in those countries. So what Chinese companies are facing are rising costs and falling sales prices. And that's going to hit those businesses on both sides, an increase in their cost base and a reduction in their revenue. So that will mean either lower profitability or potentially losses. And if we get a lot of Chinese manufacturing companies continuing to make losses, then they may become insolvent and therefore may have to stop trading. And that would have a really negative impact on the Chinese economy because manufacturing is the heartbeat of China. It accounts for around 30% of total GDP. And when we look at this chart and see that prices have been falling consistently year on year for Chinese manufacturers, that's going to take a huge chunk out of their profitability and therefore will have a further negative impact on the Chinese economy as a whole. Now, the traditional way of dealing with problems with inflation is to move interest rates. And as we've discussed over the last 18 months, because of problems of high inflation around the world, most economies have been increasing their interest rates, which by definition increases the cost of borrowing and therefore discourages both companies and consumers from taking on new debt and ultimately leads to a reduction in demand and therefore a reduction in prices. But when you have a situation where prices are falling, it's the reverse logic. You need to reduce interest rates, which has the knock-on impact of reducing the cost of borrowing and also reduces any interest that people are being paid for keeping their money in the bank. And this should result in an increase in spending and therefore demand and ultimately lead to an increase in prices. This chart shows the movement in the official rate of interest in China dating back to the start of 2022. And you can see that the Chinese authorities have reduced interest rates on 4 separate occasions since the start of 2022. However, the level of the interest rate cuts has been relatively small. At the start of 2022, the official rate of interest in China was 3.8%. At the beginning of the year, the authorities introduced a 0.1% rate cut, taking the official rate down to 3.7%. In the middle of 2022, the rate was cut by 0.05% to 3.65%. There was a further cut of 0.1% in the summer of 2023, and in September 23 the rate was cut by a further 0.1% to the current level of 3.45%. Now, if we compare the approach taken by the Chinese central bank to what's been happening in the USA, you can see that since the start of 2022, the Fed has introduced 11 interest rate increases, and the official rate of interest has risen from 0.25% to 5.5%. So that's a movement of 5.25%, which compares to a movement of 0.35% in China over the same period. And I think what this really indicates is that if the Chinese authorities are serious about removing deflation from their economy, they're going to have to take a more aggressive approach with interest rates. Normally when we talk about inflation, the key issue is rising inflation, prices rising faster than anybody really wants them to. But in today's video, we're talking about deflation. So what causes prices to start falling? This graphic summarises the main causes of inflation. And if you look at the left-hand side here, you can see that falling demand is one of the main drivers. And on the right-hand side, it's lower costs of production. So let's talk about the lower costs of production first. As you can see on the right-hand side here, we've got 3 different boxes: lower oil prices, improved technology, and falling import prices. And the logic here is that if a company is experiencing a fall in costs, so oil prices have fallen, which means that they're now paying less for all of the oil products that they're buying. They've got improved technology, which means that they can do things more efficiently and therefore cheaper. And if the cost of the raw materials that they're buying in has gone down, that means that they've got a reduction in their overall costs. So if a company finds itself in this position where its costs are actually falling, it has 2 choices. Firstly, it can continue selling all of its products at the same price and make a larger profit, which is what most businesses would do if they could get away with it. Or they can decide to reduce their own selling prices. And in that situation, the company could actually potentially still make the same amount of profit or even more profit, depending on how far the costs have fallen and how far they decide to drop their prices. So this is really a business decision. And the main reason that companies would decide to drop their selling prices is because of competition. If all of their competitors were in the same situation, so everybody was seeing a reduction in their costs, and therefore somebody started cutting their prices, you could find yourself in a falling price war, where everybody is dropping their prices to try to get more market share, and everybody therefore is reducing the amount of profit that they could make. Now, the key question that I wanted to ask at this point is whether or not this is happening in China. Is this a good explanation as to why China is experiencing deflation right now? Well, in terms of oil prices, this time last year, a barrel of Brent crude oil was trading for around $90. Today, it's trading for around 82. So year on year, there has been a reduction. However, if you look at the movement of this chart, you can see that oil prices have fluctuated up and down. So there hasn't been a consistent reduction in oil prices. This isn't really something that a company would pass on to consumers, because if it's moving around on a daily or a weekly basis, that isn't something that you can bake into your cost base. And just in case you're thinking that China has been buying a lot more oil directly from Russia, and therefore has seen a year-on-year reduction in its total oil price bill, this chart shows the movement in the price of Russian crude oil. And you can see that this time last year, a barrel of Russian crude was trading for $73. Today, it's trading for $70. So year on year, there hasn't been a major fall in the Russian oil price. And actually, if you look at what's been happening over the last few months, the price has been going up. So the overall summary here is that there hasn't really been a major fall in oil prices that has driven the fall in producer prices in China. If we now talk about improved technology, China is always looking to improve its manufacturing systems to try to automate as much as possible and reduce the cost base. However, over the course of the last 12 months, there haven't really been any significant developments that would explain why China is now experiencing deflation. And the final factor here is a fall in import prices. Has China seen a major fall in its raw material costs as a result of falling prices around the globe? Now, as I'm sure you'll be aware if you follow the channel, over the last 12 months, inflation has been a major problem in most of the large economies. And even though inflation is now starting to fall, we are still seeing year-on-year increases in prices. So inflation may have fallen from 7, 8 or 9% to 3, 4 or 5%. But 3, 4 and 5% inflation still means that you've got a year-on-year increase of 3 or 4 or 5%. There isn't a decrease. We are not seeing deflation hitting very many economies, and therefore there hasn't been a significant fall in the import price for China. In fact, import prices have been going up, and because the value of the yuan has fallen over the last 12 months, the relative cost of those imports has actually increased even further. So in terms of the question as to whether or not the deflation in China is being caused by lower costs of production, I think we can categorically say that deflation is not the result of lower costs of production. Now, looking at the other side of this chart, which talks about falling demand resulting in deflation, we've got 4 different contributing factors here: global recession, fiscal austerity, decline in confidence, and fall in money supply. So taking the first of those, are we in a global recession? Well, over the last 6 to 9 months, there has been a global slowdown. Economies are experiencing a reduction in terms of their overall GDP. However, we are not in a global recession. A number of major economies, such as Germany and the UK, are skirting very close to recession and may find themselves in an official state of recession at some point over the next 12 months. However, we are not currently experiencing a worldwide global recession, and therefore that can be discounted as to the reason why China is experiencing deflation. In terms of fiscal austerity, that describes the situation when a government has to scale back on its spending, and we saw a lot of that after the global financial crisis. When countries got themselves into difficulty, a lot of countries had to bail out their financial services sector, and as a result of that, there was a reduction in the amount of official government spending. And when you get to that situation, it becomes a vicious circle because there's less money in the economy, people are receiving less money, therefore they're spending less. That results in a reduction in demand, which can cause deflation. Now, in terms of what the Chinese government is doing, they haven't embarked on an official fiscal austerity program. However, what they have done is cut all of the debt supplies to the property sector. Now, as I'm sure you'll be aware if you follow the channel, the property sector equates to around 1/3 of the Chinese economy. And over the last 20 years, huge property development companies grew up, which were fueled by debt. They had an almost unlimited supply of debt, which they were using to build whole cities all across China. And property became the number one investment for consumers in China. People literally couldn't buy these things quick enough. However, in August 2020, the Chinese authorities introduced their 3 red lines policy, which reduced the amount of debt that property developers could get their hands on. And as a result of that, many of the large developers became insolvent and resulted in a major property crisis. And that property crisis has led to a crash in the property market in China, a reduction in prices, and a complete loss of confidence amongst Chinese consumers. So whilst the 3 red lines policy isn't actually anything to do with fiscal austerity, the end result is a very similar outcome, because what we've seen is a huge reduction in the amount of cash that's moving in the Chinese economy, because people are no longer buying lots of property. The property developers aren't able to either finish the properties they've started or sell the ones that they have completed. And so this has led to a major contraction in consumer demand. In terms of the next box on this chart, the decline in confidence, what we've just discussed about the property market is a major issue for the Chinese authorities. There has been a complete loss of confidence in the number one asset that Chinese consumers were investing into. Many families in China were putting their whole life savings into buying apartments. And because the value of those apartments has fallen, and also lots of people have lost money on deals that they've struck with property developers on apartments that have never been built, the decline in confidence has not been contained to just the property sector. It's hit all consumers, and everybody now is nervous about spending money, and they're holding on to their savings, and this has resulted in falling demand. And that fall in demand is one of the key explanations as to why China is experiencing deflation right now. In terms of the final box on this chart, the fall in money supply, well, officially China is still pumping money into the economy, but one of the key areas historically was the supply of debt to the property developers. So whilst the Chinese authorities weren't actually giving the property developers that money themselves, it was coming from the Chinese banks. And because the Chinese authorities have now stopped all of that money supply, in an inadvertent way, they've actually reduced the amount of money that's flowing through the Chinese economy. And that's another explanation as to why we have got deflation in China today. The final box to mention on this chart is the one in the middle at the bottom, which says negative inflation expectations. And the reason that can become a cause of deflation is that if you can see prices are falling month on month, you may decide not to buy something today, but rather wait for another few months until it becomes cheaper. And that then becomes a vicious circle, because everybody's sitting back, not wanting to make a purchase, holding onto their cash because they think that prices are going to continue going down. And so it does become a very vicious circle. And whilst that isn't the main cause of Chinese deflation today, it does become a contributing factor. Once prices start falling, people become more cautious about spending, and so it goes on. I thought it was worth comparing what's happening in China to what's happening in other countries around the world. And this chart shows the current rates of inflation for the G20, which are officially the 20 largest economies in the world. And as you can see, China isn't actually the country with the lowest level of inflation in the G20. That accolade goes to the Netherlands, which experienced a fall in prices of 0.4% in October 23. China's number 2 on this list with a fall of 0.2%, and no other countries are experiencing deflation. Prices are currently rising in every other country in the G20. And as you can see here, the countries with the lowest levels of inflation at the moment are Saudi Arabia at 1.6% and Switzerland and Italy at 1.7%. And if we look at the bottom of this list, which shows the countries with the highest official rates of inflation, you can see that currently South Africa and Australia have inflation of 5.4%, Russia 6.7%, Turkey 61.4%, and Argentina's official rate of inflation right now is 143%, which means that year on year, prices have risen by 143%. And when you compare that to what's happening in China, where prices are falling, you can see that this isn't a global phenomenon. And this table shows the countries with the lowest levels of inflation in the world. And as you can see right at the top of this chart is Cameroon, where on the last official set of data, prices fell by 16%. That was in August 23. We don't have any figures for September or October yet. The country with the next highest rate of deflation is Afghanistan, where prices fell by 8.1%, followed by the Seychelles, where prices fell by 2.7%, so it might be a good time to go on holiday to the Seychelles if you've been thinking about it. Burkina Faso, where prices fell by 1.6%, Costa Rica, where prices fell by 1.3%, Benin saw a price fall of 1.1%, the Netherlands we've talked about, but Mali also saw a fall of 0.4%, Thailand saw a fall of 0.3%, China we've talked about, and Bahrain is the 11th country in the world that's currently experiencing deflation. Every other country in the world is currently experiencing price rises, which once again confirms that the reason for the deflation in China isn't because we're seeing lower prices all around the world, it's predominantly because of reduced demand. So what's the summary and conclusion today? Well, I wanted to post this video because I think deflation is a really interesting topic. Over the last couple of years, we've talked a lot about inflation, the fact that prices were rising higher and higher in most economies. And the way that most of those countries have dealt with high levels of inflation has been to increase interest rates, increase the cost of borrowing, to discourage people from taking on more debt, and also increase the cost of some of the existing debt, and therefore people stop spending, it reduces demand, and prices should go back to a normalised level. That's what's been happening in most economies, but it's not happening in China. What China is experiencing is a year-on-year fall in their prices. And as we've discussed in today's video, that throws up its own problems. Because what happens at times of falling prices is that the companies in your economy can't pass on any cost increases. So if they're having to pay more for all of the things that they're importing, they just have to absorb that cost. They also aren't in a position to be able to increase anybody's wages. So you get wage stagnation. Everybody's paid the same or potentially even less than they were this time last year. Now you may be thinking, well, does that really matter? Because if prices are falling, then nobody needs to get paid anymore because you can buy the same amount as you did this time last year. And whilst that might be true in theory, psychologically, everybody has got used to receiving pay increases. You expect to get your 1 or 2 or 3 or 5% increase because that's what you've experienced historically. Now, if you don't get that pay increase, it might mean that you become less motivated, disgruntled, unhappy at work. And as a result of not getting a pay increase, you may decide that you're not going to spend as much, that you're going to be a bit more cautious about what you're buying. And as a result of that, demand starts to fall. And these factors have all contributed to China's current situation, where they've got reduced demand domestically, which has caused prices to fall. And now everybody's thinking, do I buy now or do I buy later? Because if prices continue going down, I may as well hold off and buy something in a month or two's time. And that is the vicious circle that is very difficult to break out of. And in terms of how the government actually goes about fixing this problem, it's the opposite of what we've talked about. Rather than increasing interest rates, they need to reduce interest rates. But as we've seen from Japan's experience, once you reduce interest rates to zero, which they did many years ago, you've got nowhere left to go. You can't actually do anything to encourage people to spend more. So the other alternative that government has is to pump more money into the economy through quantitative easing. But what Japan found was that as they were doing that, people were just saving more. And so as the money was going into the economy, consumers were snaffling it away and saving it for a rainy day. So that didn't work either. And these are the dilemmas that China is currently facing. So it's going to be very difficult for China to get itself out of this situation. And the continued global slowdown that we're seeing isn't going to help because the Chinese economy is geared up for exports. It manufactures products which it sells to all the other countries around the world. So when you get a situation where those countries want to buy less because their own economy is slowing down, that's a problem for China because there is no alternative market for that volume of goods. And if domestically demand is also reducing, it's a double whammy from China's point of view. So the overall summary of today's video is that China have been struggling with very low levels of inflation for the last 7 months and have now moved into a state of deflation. And when you look at all of the reasons why that's happened, it's going to be a very difficult problem for the Chinese authorities to solve at a time when there's already major problems going on anyway. The property sector is still in a state of tatters. The property developers are continuing to be illiquid. They can't get their hands on any cash to be able to finish the builds. We've got restructurings being put forward by companies such as Evergrande and Country Garden, which are two of the biggest companies in the world. We don't have a resolution on that side of things. Chinese consumers have lost total confidence in the property market. So whilst 20 years ago this was seen as the holy grail, everybody wanted to buy property, people were putting their life savings and more into all of these deals. They've now discovered that prices can actually go down as well. A lot of people are nursing losses, so there's been a complete loss of confidence. And that loss of confidence has moved over into the general psyche for Chinese consumers. They're now a lot more cautious about spending and buying things. That's resulted in reduced demand in the domestic market, which has now resulted in deflation. And this is going to be a very difficult nut to crack for the Chinese authorities. So hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. And here's something to put a smile on your face.